How's it going, guys? My name is Andrew, and if you are like Professor Meatball, you have questions. You have questions about the Quadruple Witching Day, and that's why I want to be able to answer it. We have to look over here. Vlad L asked, "Hey Andrew, excellent work, my man. Thanks for your effort. Just wondering your opinion on this Triple Witching Day, March 19th, otherwise upcoming call options. Actually, it is a Quadruple Witching Day, and that is what we are going to cover here in this video as simply as possible for any smooth-brained ape to fully understand. Quadruple Witching refers to a date on which stock index futures, stock index options, stock options, and single stock futures expire simultaneously. While stock options contracts and index options expire on the third Friday of every month, all four asset classes expire simultaneously on the third Friday of March, June, September, and December. Quadruple witching is similar to triple witching days when 3 out of the 4 markets expire at the same time, or double witching when 2 markets out of the 4 markets expire at the same time. Here's some key takeaways, and then we're going to cover why this might cause some real sneaky news for Meme-ageddon. Quadruple witching, AMC, BB, NOK, GME, and RKT in this DD by Reddit user Boss Hacks. Key takeaways. Quadruple witching refers to a date on which derivatives of stock index futures, stock index options, stock options, and single stock futures expire simultaneously. While it may result in increased volume and arbitrage opportunities, quadruple witching does not necessarily translate to increased volatility in the markets. And finally, quadruple witching days witness heavy trading volume, in part due to the offsetting of existing futures and options contracts that are profitable. If you guys have followed the interview with Josh Hayes Pixel, he mentioned in his DD that the quadruple witching day is evidence that squeeze is likely on March 19th, and March 19th is the next quadruple witching day. So we are talking about it. Why exactly does this user think that this is the Meme-ageddon? So this is a once in a quarter event. It does happen 4 times a year. And let's look at a real company and the outstanding call contracts with the most open interest. We got Tesla. We got on the 12th, 19th, 12th. We got Apple on the 12th and the 19th. These mega caps are seeing a 10x increase in options contracts on March 19th. Now let's see a less sexy big stock, Walmart, right, on the 12th and the 19th, and now AMC on the 12th and the 19th. AMC has more call options than Tesla right now for March 19th and over 10x Walmart. They have about 50% Apple, and you guys know how big Apple is, right? We also have BlackBerry, Nokia, GME, RKT, The Theory, and get on your tinfoil hats now. You got them on? Okay. They think that someone or some peoples have discovered the incredible power of near-term options and their influence on the upward volatility on price. As more options are bought near the money, it causes a delta spike as market makers buy shares to hedge. We've talked about so many different kinds of spikes. We've talked about short squeezes, we've talked about gamma squeezes, and now a delta squeeze. Very similar idea, but let's say that the stock is currently $1,000. Well, I think it'll reach $1,200, so I'll buy the option to buy it at $1,200 in the near future, and I'll have to pay a premium, but it's worth it to me. Thank you for the super. I'm going to cover you in just a second, Chris Merck. But the me that bought a $1,200 stock price, as the price starts to the call option at a strike price of $1,200, as the price of the stock starts to increase from $1,000 to $1,200, the hedge fund or the market maker, whatever institution sold me that contract, they can end up hedging against it. They could end up buying the stock now before it reaches $1,200, and therefore they'll make a profit because they are predicting it will also reach $1,200. So in that sense, they are buying the stock, which increases the price and causing a delta spike. Very similar to a gamma spike when your contract is actually in the money because your strike price is lower than the price itself. It also necessitates buying from the institutions and market makers themselves. So this normally isn't enough to do much, but add in some marginal ingredients, including but not limited to highly volatile stocks, heavy retail interest, significant short interest, a small float, inclusion in ETFs, index funds, and other funds. As the price rises close to the strike price, we also see the gamma spiking. Personally, I think that we saw delta hedging yesterday on BlackBerry, huge volumes around 11 a.m. What does it all mean? Well, hold on to your bananas. This thing is bigger than us. If your prices on some of these stocks rise, they will need to be recalibrated for weight for inclusion in their index funds. This creates a lot of buying and selling, which exasperates the volatility further. The more volatility, the more market makers have to hedge. I think we are in for a once-in-a-lifetime historical volatile ride. If you hold stock, you can ride it out and better time it. If you hold options, you are really hoping your timing works well. Something big is going to happen leading up to March 19th, and the way that the call contracts are organized creates a kind of series of landmines just waiting to be tripped. Each mine sends the price further more volatile. What's more interesting is these stocks all seem to be related in a basket by the algo computers. This does mean that there is a degree of echo where what happens in AMC affects BB, for instance. It might mean we see some double feedback happening as well. We did see it originally in January, and no one has been able to explain exactly why yet. I think January was a test, a proof of concept. The real prize is March 19th. Good luck, and of course, this is not financial advice. You guys knew that already. Make your own decisions, make your own research. Well, if you guys have learned anything, thank you, Vlad, for the option to answer your question. Not the obligation, of course, just the option. What do you guys think? Because we've covered in the counter DD by Anchored Stone yesterday that the short attacks actually might come out in force on this day, March 19th, or leading up to March 19th, because of the gamma squeeze and delta squeeze possibilities. So when all of these institutions come into play, can the mother of all short squeezes actually end up being the mother of all short attacks instead? If that scares you as much as it scares me, leave a comment down below. Drop your opinions down there. Have positive vibes and good discourse. Don't be afraid to speak your mind. And most importantly, if you guys are just joining the Meatball sub, the sub button is right down below. Make sure to grab it on the way out. Make sure to hit that bell button too so you don't miss another live stream. And for Meatball's sake, hey, consider supporting the stream however you can. Coming to a live stream on time, coming and commenting in the live chat, or just interacting with a couple of the links down below. Because for now, but not for forever, I hope you guys have a nice day. Peace.